Welcome back to Epic Inkwell, your ultimate source for gripping tales and unbelievable real-life stories. If you're new here, make sure to hit that subscribe button and ring the bell icon so you never miss an epic story. And for our returning viewers, thank you for your continued support. Don't forget to like and comment below. Today, we dive into one of the most staggering financial meltdowns in history. This is the incredible tale of Bill Hwang and how he lost between $20 to $30 billion in just a couple of days. Buckle up, because this is going to be a wild ride. Our story begins with Bill Hwang, a name that until recently was relatively unknown outside financial circles. Hwang, the founder of Archegos Capital Management, was a titan in the investment world, known for his bold and aggressive trading strategies. Hwang started his career at Tiger Management, a prestigious hedge fund, where he learned the ins and outs of high-stakes investing. With a sharp mind and an appetite for risk, he quickly climbed the ranks. In 2001, he founded Tiger Asia Management, which later transformed into Archegos Capital Management. Under his leadership, Archegos grew into a powerhouse, amassing billions in assets by leveraging heavily on borrowed money. Archegos operated with a strategy that involved using swaps, complex financial instruments that allowed them to take massive positions in stocks without actually owning them. This meant Archegos could control huge amounts of shares with relatively small amounts of capital, amplifying both potential gains and losses. But as with any high-stakes game, the risks were immense. The first cracks appeared when Hwang's position started to go south. His firm had significant exposure to a handful of high-profile stocks, such as Viacom CBS, Discovery, and Chinese tech giants. As the market began to turn against these positions, the true scale of Archegos' leverage came into the spotlight. In late March 2021, Viacom CBS announced a secondary stock offering, which led to a sharp decline in its share price. This triggered a chain reaction. Archegos' heavily leveraged positions began to unravel, causing panic among the banks that had lent them money. These banks, including Credit Suisse, Nomura, Morgan Stanley, and Goldman Sachs, started to demand more collateral from Archegos to cover the falling value of their positions. When Archegos couldn't meet these margin calls, the banks had no choice but to liquidate its holdings. This flood of selling led to even further declines in stock prices, creating a vicious cycle. Within 48 hours, Archegos' positions, worth between $50 to $100 billion, were wiped out, leading to losses estimated between $20 to $30 billion. The fallout was immediate and severe. Major banks reported billions in losses, and regulatory bodies began scrutinizing the lack of transparency and oversight in the use of swaps and leverage. Bill Hwang, once a billionaire and a respected figure in finance, saw his fortune evaporate almost overnight. So, what can we learn from Bill Hwang's dramatic downfall? It's a cautionary tale about the perils of high-risk, high-reward strategies in the financial world. Transparency, due diligence, and a clear understanding of the risks involved are crucial for both investors and the institutions that support them. Thank you for joining us on this epic journey through one of the most shocking financial collapses of our time. If you enjoyed this story, please give it a thumbs up, share it with your friends, and let us know your thoughts in the comments below. And if you haven't already, don't forget to subscribe to Epic Inkwell for more incredible stories from around the world. Until next time, stay curious and stay informed.